we're not necessarily in a recession yet, although we have kind of pre-recession, warning signs, or early recession warning signs. But when you have like a yield curve disinverted, when you have economic activity slowing down, when you have a purchasing managers index sharply rolling over, all that's pointing towards recession. So I think you can only give them a full grade after the fact. I think we do have enough information though to obviously be critical of the Fed. I mean, they were, talking about how they were going to not even thinking about raising rates, that they were going to hold rates low for years, that any inflation would be, not that big of a deal and transitory. Then you had a massive inflationary spike, and then they suddenly shifted course and started changing everything. And you can imagine how if you're, you're actively managing the price of money, if you're actively managing the ledger that everybody uses, sharp changes like that and flip-flopping your outlook and your what you're calling for can cause quite a lot of disruptions. So I would say that, I think they're obviously their models need updating. I don't think they were dismissive of the sharp growth in broad money supply, saying that that's not going to be a big factor for inflation. Where there are a bunch of us saying, no, it's very likely to be, with a mild lag, a big impact on inflation. And so now they have arrested that, they have helped that roll over and solidified that, but now they're doing so generally through the lens of demand destruction. So it's like you out of the frying pan into the fire, and I think they're going to have another issue to go with after over the next year or two. So I think he is, but I think the Fed put is already a little bit different than people suspect it is. They often think that the Fed jumps in when the stock market goes down, and under Greenspan that was to some extent true. That was kind of I think the worst era of the Fed put. Under Powell, from the very beginning of his tenure, he wasn't jumping in just because the stock market was going down. He would jump in because other things broke. He, in the famous Powell pivot of late 2018, early 2019, that was because credit markets broke. People looked at the 20% drawdown in the S&P 500 and were like, oh, that's why Powell changed course. And it's like, no, underneath the surface, there were the bigger part of the iceberg was breaking, and that's what Powell responded to. Same thing in March 2020, Treasury market broke. Also the repo spike in 2019. These were all deeper plumbing issues. And so I really don't think Powell's doing anything different than he's already been doing, which is he's only willing to respond to deeper things in the system breaking, not equities. And for the past, this whole tightening cycle, none of those types of markets have been breaking. Credit markets have not been breaking. Treasury markets not, it's been low liquidity, high volatility, but it's not been broken. No repo issues. And so he's willing to basically tighten until he either causes an outright recession or gets inflation super low, or one of those kind of aforementioned, deep system things breaks. So again, part of it is that it happens so quickly and it's not had time to fully go through the system. Monetary policy happens with a lag. And so just because interest rates are higher, most debt remains unaffected because most debt is fixed rate and just matures over time. So it's just over quarter after quarter, that'll start playing into interest expense. And another factor is that going back to that Q4 of last year, liquidity change. So as economic indicators slowed down, as the market started to get less hawkish about what they thought the Fed was going to do, that took the edge off the dollar index compared to other currencies, and that's kind of allowed for a rebound. And so, for example, late last year, the Treasury market was looking really bad. It was looking increasingly illiquid. Auctions were, Treasury auctions were doing really poor. And generally you get a very strong inverse correlation where if the dollar is strong, the foreign sector is selling treasuries or not buying treasuries. And so all that was kind of a negative loop, causing more and more distress and liquidity problems in the treasury market. But by weakening the dollar, as the market started to say, okay, Powell's not going to go to raise rates too much more, they started taking the edge off the dollar, and that actually improves the treasury market. Now foreigners can come in and buy some treasuries again, at least stop selling treasuries. And so you have basically this temporary improvement in liquidity that has allowed things to keep going. And kind of the two main components of domestic liquidity, one of them is the Fed's balance sheet, which they're still drawing down. That's the part that hasn't taken a reprieve, it just keeps going down. But the other big one is the Treasury general account. So the Treasury Department holds their cash balance at the Fed, and the Treasury has control over that. They can bring money in, they can put money out based on how much bonds they're issuing, how much they're spending in a given period of time. And ironically, because of the debt ceiling issue, one of the things they're doing to delay the issues caused by the debt ceiling is they can draw down their cash balance and basically spend more into the economy than they're issuing for bonds. And so when they draw that down, that's actually positive for liquidity. And so partly the past quarter, you've had the Fed still draining liquidity with their quantitative tightening, but then you've had the Treasury general account adding to liquidity. And that could happen for a few more months until the Treasury general account runs out. And then that's where I think you get a resumption of probably negative liquidity conditions, assuming the Fed is still able to do quantitative tightening at that point. So partially, yeah, basically, if you look at the Treasury's own forecasts, they actually, every quarter, they give an assessment of what they think they're going to borrow and spend over the next 2 quarters. And then they update that every quarter. And they give like a quarter end target for what they think their Treasury general account is going to be. And they expect it to be much higher. They expect it to go up to 700 billion, and then they kind of settle around 500 billion. But instead, they've been staying under 400 billion.
Right.
And they've not hit their own targets.
Mm-hmm.
And so they've essentially left more liquidity in the market than they said they would.
Right.
And I think it's hard to say for sure what reason that is, but I think a lot of it has to do with the debt ceiling. And when the U.S. government runs into a debt ceiling issue, it's not that like this week, like roughly today, they're running into the debt ceiling. That doesn't mean that they quote unquote default today. They start turning to what they call extraordinary measures, where they can do partial government shutdowns to spend less, per month. They draw down from the federal employees, like it's called the G fund, is where they hold some like treasuries. They pay it back after it gets refinanced, but they kind of draw from that. And then the other thing they do is they draw down that Treasury general account. It's like, imagine if your income got shut off tomorrow, but you had a bank account. You just like, well, I'm going to keep paying the bills for the rest of the month until I'm fully out of money. That's essentially what they do once you hit the debt ceiling, but before you actually run into that that crazy default period. And ironically, that's good for market liquidity because they're just like they're taking their existing bank balance and they're just kind of slowly putting that into the economy without drawing money from the economy for treasuries. Yeah, a lot of it is political theater. The way that was established in I think 1917 and about 100 years ago. And the reason they did that is because before then they had to like authorize every specific like bond issuance. So that the Congress would say, this is what we're going to spend, and you're going to do like 5-year treasuries. So you basically micromanage the treasury. And of course that became, especially during World War I, that became too big and too unwieldy for Congress to do. So the Congress said, okay, we're not going to micromanage the treasury issuance. Instead, we're going to say, okay, the Treasury Department could figure out, they're the accountants, they can figure out exactly what durations and what instruments they want to use, and we'll maintain a ceiling and say, okay, issue whatever you want as long as you don't exceed this ceiling. It's kind of like the Congress is acting like the board of directors, and they're letting the Treasury Department act like the CFO, which makes sense. But then, you basically, obviously you ratchet that up every quarter, every year. And for decades, that wasn't really used as like a political tool. But in this current age of like, heightened political polarization, it's a chance for the out of power party, at least the party that doesn't have the presidency, to use that to basically get concessions or draw attention or try to build momentum for their next election. But then of course when they're in power, it's like, oh, it doesn't matter, we don't have to worry about the debt ceiling, and then you're out of power again and you're freaking out about the debt ceiling. So a lot of it is theater and just kind of politicians using the tools that they have available to them.